Good afternoon, it's Chris Robinson Ag Marketing with today's post-close grain and commodities comments for Thursday, the 15th day, halfway through the month. I think the biggest surprise was that Ghana still they cut their production by a little bit, but it's still going to be a record crop coming out of there. Some decent sales for corn. Corn sales continue to be good. Bean sales on target. Looks like China is could be getting in the market to go ahead and start for their 2026 commitment to us. Supposedly, they're supposed to go back to doing their normal 25 million metric tons, which would take about a billion bushels. So uh, the market liked that. You did have a little bit of a bounce in beans, but long term, I'm still concerned about downside risk. If you got my afternoon, the letter I sent out today, it did go out in the afternoon, but it's because I wanted to go through some stuff. I pointed out the long-term continuation chart really for corn, wheat, and beans. I've talked about how there's potentially, 40, 50 cents worth of risk in corn. There's 50 cents to $1 risk in beans. If we go down and test the long-term bull support trend line down there, and all those trend lines, they go back like, 20, 25 years. So it's a really long-term support. So hopefully we can find some support before that we have to go and test those. But when somebody calls me up and says, what's the risk? All I can do is point out what the risks say on the chart. Me pointing out the risk is there is not me promising we're going to go there. Please don't try and paint me into that corner. Um, this program is about defending lower prices until we sell our grain, right? If I knew exactly where the prices were going to go, why would we even hedge, right? Why would you even be a farmer or a rancher? You would just be a virtual farmer or a virtual rancher. So, what I'm trying to do, I got to be clear about this, is trying to help you manage your risk. Nobody wants to price corn or price bushels of anything right here, right now. So, but you can get a substitute sale in the form of these shorter dated options. And yes, the ones that we used right before the last USD report worked, quote unquote worked. You put that in quotation. What does that mean? Well, we spent 4, 5, 6, 7 cents for them, and they protected us against that 30-cent flush. You can still do the same thing. You can go out and get some very cheap protection. The next big report is going to be plantations. That's March 31st. So can you tell me what's going to happen between now and March 31st? No, you can't. Nobody can. But we know that's probably the time frame that we've got to be looking ahead as we look at what risk means. So based on that, you can still defend stuff and you don't have to spend a whole lot. So don't let, the high of the move so far for these corn was 473. I have some 465 hedges for people that wanted them. I talked about that today in my letter. We bought them not because we were hoping that they were going to pay off, but they have paid off. Now, it would be nice. Wouldn't it be nice if you had a big chunk of your 2026 corn hedged at 465 when we're trading at 445? When the risk is that, we could fall further. So you could protect at the money 445 or 440 corn right now. I broke that down in the letter. Same thing with new crop beans. We're at 1064. We got up to 1130. Don't want to be sitting down at 1030 if we fall all the way down there at 1028 when you could have protected, 1060 or 1050 beans for not a whole lot of money. So the whole idea is if you are a farmer producer, you want prices to go higher, and we're all bullish, but we don't want to get left holding the bag if there's another flush lower. So I saw a lot of stuff in social media over the weekend. No, the USD did that. Um, you have a defense against that, right? It's like walking out into a playing against an NFL defense and not having a plan in case they come at you with the blitz. You have to know how to pick up the blitz. These puts are like, picking up the blitz. So I don't know what to tell you. Yeah, you can be as adversarial as you want all day with the USDA. It's probably a good way to approach it because if you're a farmer producer, um, their information can can do one of two things. It can hurt you or it can help you. And when it hurts you like this, it's very frustrating. You get very angry and then you make bad decisions. So a hedge can help you not make bad decisions. And the good thing is, I can't say this enough. 15 years ago, 2010, I started working with farmers and producers. You didn't have these shorter dated options. You had to do March, May's, or you had to go out and buy 300 days the whole year. It was expensive. I mean, we used to spend 50 cents on corn puts and, you know, uh, 60 cents, 50 cents on soybean puts. We'd spend 30 on corn, 50 on beans, just as an initial downstroke. We spend 30 cents on an option, it's 1,500 bucks. If you have to protect a million bushels, that's 200 contracts times 1,500 bucks. So off the bat, you're spending all that money. Now, with these options, literally, I mean, I've spent 4, 5, 6, 7 cents, and you have to understand what the purpose of the option is. The option is there not to make money, right? I'm not George Soros. I'm not telling you, or I'm not Paul Tudor Jones saying, I promise you, if you buy this for 4 cents, you'll make 50 cents. That's insanity. Was a defensive hedge, period. Okay. And then once you have those defensive hedges on, you've got to manage them. So, a lot of guys, I've got to be clear about that. I'm not running the hedge fund. I'm not asking you to give me $1,000 and I'll hope you turn it into $1 million. What I'm trying to do is help you market your grain when you want to market your grain, as opposed to feeling like you missed the boat, the market drops 50 cents, and then you have to sell. You're selling as a weak hand. So now that's number one. Number two, again, there is still risk out here, right? Me pointing out risk is not promising you we're going to go there. I pointed out risk before the report. I wasn't promising we go there. So, all right, just got to be clear about that. I think a lot of guys, some people already know this. If you already know it, pardon me, I don't want to offend you or insult you, but there are a lot of guys out there that don't really understand how a hedge works. So this is intended for them. If you're not getting my letter, please sign up for it, robinsonagmarketing.com. If you want to call me, and I'll send you a couple freebies to get you started. If you don't want to, sign up right away, I get it. Who am I? Oh, I spent 22 years trading at the floor of the board of trade for my own account. I was not a broker. I did not handle clients, customers. All I did was trade my own account. In 2008, 2009, the market really left the floor. So I had this skill set that was meaningless from trading in front of a screen. Luckily, I had some friends that were already in this hedging business, working with farmers and lenders. Um, so I transitioned to that in 2010. And here I am 16 years later. We're still working with farmers and producers. And so it was a learning curve for me to learn how to kind of talk to farmers and producers, try to explain to them what we're trying to do. But the way I look at it is this: if you're a farmer or producer, you're basically an elevator, right? You own all the grain that you own in the bin right now, and every bushel that you're going to grow for the next 30 years. So all you are is bet long. So you need to have a defensive strategy for when the markets, move on you lower like this. And it works both ways. I can't believe I did a webinar last night. 4 years ago, 2022, we had $8 corn, we had $17 beans, right? And it was, happy days are here again. So in 3.5, 4 years, we have a completely different situation. And 3.5 years, 4 years from now, we could be in another situation. Markets don't stay stagnant. So we're going to try and do the best we can with what we have right now, without a crystal ball. That's what I'm working on. That's what I try and do for all my clients. In the overall scheme of things, again, we're a little bit of a bounce in beans today, but we couldn't really get anything going. We couldn't get above 1060 in March. We settled up a dime. We'll see how we settle tomorrow. Friday's report's going to be very, very important. How we settle on the week. March corn was down a penny and 3/4 at 420 and a quarter. Again, what am I worried about? I'm worried about if March corn takes out 417, then we're dancing again with the contract low at 410. Chicago March wheat down 2 cents. Kansas City wheat March down 5 cents. Both those markets are struggling with whatever happens with corn, to tell you the truth. And the exports today weren't that good for wheat. They have been tremendous for wheat because end users are looking at it going, we're at or near 5-year lows. But there's more risk. There's probably 40, 50 cents worth of risk in wheat if we really get after it, if corn starts going lower. So all this stuff needs to be defended. Okay. And you don't have to spend a whole lot. If you don't take anything away from this conversation, listen to me talk. You need to defend what you haven't sold, and you do not have to spend a whole lot of money. Flip side, new highs today in the protein complex. Lean hogs leading the way. There's some story. There are some. There aren't stories. They're in the press in Spain. Some of the wild boars have got ASF. If that was to jump into their commercial herds, Again, the market loves, scary stories like that. ASF is very, very bad. You don't want that over here. But what it does is it suggests that, they may have to come over here or go elsewhere for their pork supply. So a nice move in the hogs today. We've rallied about 14 bucks in the past 6 weeks. You look at the feeder cattle, a new high for the move today. We got almost the 365. The next stop for March feeders is there's a gap up there. It's 370 to 375. And I'll tell you this: if I told you back on um, November 25th, Thanksgiving, when we were trading at 293, that, oh, don't worry, just wait, and we'll be back up to 365, I think you would have called the men in the white coats. So a tremendous recovery, a tremendous gain in revenue. Um, I'm going to talk real quick about puts versus futures, right? Suppose you were like, oh my goodness, I need to protect my cattle. I'm going to sell the board at $3. Well, what have you done if you're short the board from $3? You've you capped your price, your profit at $3. You've made margin calls for $60, and you've left, all that on the table. If you had bought a put option, even if you had said, okay, I want to spend 5 cents, that would have been a really expensive put. Spend 5 cents on a put. Okay, you've lost the 5 cents, but you've picked up the 60 in the cash market, and you kept your floor. So that's the difference between a put and selling the board. Okay, it's a really good strategy for someone who's always bet long. It's probably not a good that great of a strategy if you want to, if you're somebody that you live in an apartment and you're just trading grains and cattle, to try and make money. That's a different approach. But from a hedging standpoint, you really want to be using these puts because you get the floor, you bite the bullet, you pay for what that floor cost you, but then you leave the upside completely open. Okay, so this is a great example of why puts are your best friend if you're a producer. And a lot of you guys, use the LRP. Those are subsidized puts. Those are great, but you can't roll them up. Once you buy them, you have to hold them until they expire. If you use the CME puts, you can buy them, sell them, move them. And for guys back then, if you spent 5 cents on a put and we rallied 65 bucks, now you're in a situation where, okay, do I want to spend another $5? Maybe I can, instead of being down at $3, I can be at 340 or 350. So you can capture a big chunk of that 40, $50 gain. Is there a cost associated to it? Yes. But there's also a cost for not having a hedge on if we were to do another swan dive and break 65 bucks. So that's really what it comes down to. That's why it's a hedge. But great day in the cattle. April fat cattle up a buck 10, finished there as well. Did not take out the high yet. If we take out 239, the next level guys are going to be looking at is 247.30. That's the top of the gap going back to October. So is there another 10 bucks to go? Sure feels like it. Stock market came back today and was finished today higher. Some wild moves in silver. If you're trading silver, be careful, right? 8 o'clock, 7:30, 8 o'clock, the Chinese opened back up again. That's what happened last night. We went from 93 to 86 in heartbeat. And then, all day long here we came back down. We're right back to 92 trading as I'm talking to you. So if you have a one lot on and it moves $6, that's 6 grand if you're trading the 1,000 ounce contracts. And we had an 8 cent range and we went down 8 cents and then back up 8 cents. So that's a $16,000 swing on a one lot. Okay. And if you're trading the 5,000 ounce bushels, you're looking at a tremendous, it's $100,000 swing, right? If you move 16 bucks on $5,000, that's a big swing. So be careful out there. All right, this is Chris Robinson, Robinson Marketing, 312-638-8868. Give me a call if you want to talk about hedges that might appeal to you. If you're not getting my letter, take a look at it, robinsonagmarketing.com. If you like it, keep it. If you hate it, delete it and block it. Take care.